Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing the latest forecasts from market experts regarding the Bank of Canada's policy rate. A majority of influential economists and analysts are predicting that the Bank of Canada will lower its policy rate to 2.5% before pausing. This prediction comes from the latest quarterly market participant survey conducted by the Bank of Canada, which polled 28 influential financial market participants. Most respondents expect the central bank to implement 2 more quarter-point rate cuts, which would bring the policy rate to 2.5% by July. Interestingly, this forecast is 25 basis points lower than the predictions in the third quarter survey, indicating a shift towards a more dovish outlook. Half of those polled believe their forecast is skewed towards a lower rate path, while only 11% think the risks are skewed towards a higher path. The Bank of Canada is expected to maintain this 2.5% policy rate until the first quarter of 2027, when a median of those polled anticipate the first rate hike to 2.75%. It's worth noting that the Bank of Canada's survey results are a bit more cautious compared to the current forecasts from the Big Six banks. These banks foresee the policy rate either remaining at 3% or falling to 2.75% in March and ending the year anywhere between 2% and 2.25%. This divergence shows the varying levels of optimism and caution within the financial community. The survey also revealed some interesting insights beyond the policy rate. The median forecast for Canada's real gross domestic product growth by the end of 2025 is 1.8%. with a slight increase to 1.9% by 2026. The strongest upside risk to Canada's growth outlook is a stronger housing market, with 82% of respondents selecting this option. On the downside, increased geopolitical risks were identified by 50% of those polled as a potential threat to growth. Additionally, the survey estimates a median probability of a recession occurring in the next 6 to 12 months at 25 to 30%, with similar projections extending to the 12 to 24-month horizon. As for inflation, a majority of respondents expect annual consumer price index inflation to remain around 2% through 2025-2026 and extending through the next 5 years. Lastly, the survey touched on bond yields and the Canadian dollar. The median 5-year Canadian bond yield forecast for 2025 is 2.88%, with projections for the 2-year bond at 2.6%. The Canadian dollar is expected to hover around 72 to 73 US cents by the end of 2025, with similar levels anticipated in 2026. In a significant development in the financial sector, Bank of America has reached an agreement to purchase a $9 billion portfolio of residential mortgage loans from Toronto Dominion Bank, according to a source familiar with the matter. This transaction marks a noteworthy move for both institutions involved, highlighting strategic shifts in their operations. Toronto Dominion Bank, one of Canada's largest financial institutions, has been actively looking to exit certain loan portfolios. In January, during a banking conference, Toronto Dominion's Chief Executive Officer, Raymond Chun, mentioned the bank's intentions to streamline its operations by divesting some of its loan portfolios. This decision aligns with the bank's broader strategy to restructure its balance sheet in the fiscal year 2025. Toronto Dominion Bank's restructuring efforts come on the heels of a significant legal challenge. Last October, the bank pleaded guilty to violating a United States law intended to prevent money laundering. As a result, Toronto Dominion agreed to pay a combined $3 billion in penalties. This legal issue has prompted the bank to narrow its focus and comply with an asset cap imposed by regulators. Toronto Dominion Bank's U.S. operations are substantial, with more than 1,100 branches and nearly 10 million customers, making it the 10th largest bank in the United States. This extensive presence in the U.S. market has been a key area of growth for Toronto Dominion, Yet the recent legal and regulatory challenges have necessitated a reevaluation of its strategy. For Bank of America, acquiring this $9 billion mortgage portfolio represents a strategic opportunity to expand its foothold in the residential mortgage market. The acquisition aligns with Bank of America's broader strategy to enhance its mortgage lending capabilities and strengthen its position in the competitive U.S. financial sector. As the financial landscape continues to evolve, transactions like this one illustrate the ongoing adjustments banks are making to navigate regulatory environments and optimize their operations. While Toronto Dominion Bank focuses on compliance and restructuring, Bank of America is seizing growth opportunities in the mortgage sector, reflecting the dynamic nature of the banking industry. Now let's turn our attention to the rental market in Ontario, where rent prices are experiencing a significant decline, reaching levels not seen in years. According to the latest data from Urbanation and Rentals.ca, Toronto, which has been a highly competitive rental market, is now seeing a notable decrease in rental rates. Despite still being the third most expensive major city for tenants in Canada, Toronto's average apartment rent is 7.1% cheaper than it was a year ago, and this decline continues month over month. The trend of decreasing rent prices is not isolated to Toronto. Other Ontario cities such as Mississauga, Etobicoke, Guelph, Ottawa, London, and Kingston are also witnessing declines in 1- and 2-bedroom rents both year over year and month over month. These reductions are part of a broader trend across Ontario, where overall rents have decreased by 4% for bachelor and 3-bedroom units, and 8% for 2-bedroom units in December 2024. This contrasts with other parts of Canada, where rent prices are generally on the rise. For instance, average rents across property sizes in Saskatchewan rose by 12% from December 2023 to December 2024. Atlantic Canada and Manitoba saw increases of 8%, and Alberta saw a 4% rise. Even British Columbia, which experienced a decline, saw only a modest 2% decrease compared to Ontario's 6% overall decline. This data underscores the unique position Ontario is in regarding rental trends. In Toronto, the decline in asking rents is particularly pronounced in shared accommodations. The typical room in a shared space now rents for $1,194, which is 9% cheaper than a year ago. This shift is creating challenges for condo investors in the Greater Toronto Area, many of whom are now facing negative cash flow. With mortgage payments, rising maintenance fees, and property taxes exceeding rental income, many investors are struggling to cover their costs. Adding to these concerns are reports of difficulties landlords face with the Landlord and Tenant Board in Ontario. There have been numerous accounts of landlords unable to enforce accountability on delinquent tenants, which further complicates the rental market landscape. These factors are contributing to a cautious atmosphere for those considering investing in rental properties at this time. As we continue to monitor these developments, it's clear that the Ontario rental market is undergoing significant changes. While challenging for some, these lower rents could offer opportunities for renters seeking more affordable housing options in historically expensive markets. We'll keep an eye on how these dynamics evolve and what they mean for the broader real estate landscape in Ontario.